Two Canadians, Margaret, David, same age, 58, same paid-off home worth $850,000, same $150,000 household income, same 7 years left until retirement. One of them borrowed against the house to invest. The other did not. 7 years later, the borrower is $32,000 behind. And the polished version of this strategy never mentioned the 4 pitfalls that put her there. Here is the order. The rate spread math is the piece that breaks the most. The CRA tracing rule is the one no one explains. The sequence of return shock is where the math actually changes. And the surviving spouse trap is the move that locks the answer in. One audience screen before we start. This walk is calibrated for pre-retirees with paid-down homes, dual income above $100,000, and 10 or more years before the strategy unwinds. If retirement income is fixed at the lowest combined bracket, if widowhood is recent, or if the horizon is under 10 years, the math is not built for that household. The walk still answers what the strategy looks like at year 7. The decision belongs with a fee-only advisor. 3 questions on the way. What 4 pitfalls put Margaret $32,000 behind? Which CRA tracing rule breaks the deduction the moment a household reaches for a windfall? And what changes when the polished 30-year version meets a 7-year horizon? Stay through the walk. Before any household talks to a mortgage broker, this is the screen tax planners reach for first. Here is the first thing. The rate spread math is what makes the brochure look free. Margaret has $850,000 of equity in a paid-off home. Her bank sets up a re-advanceable mortgage with a $200,000 HELOC. She draws it once into a non-registered, managed Canadian dividend portfolio. Because the borrowed money earns taxable income, the interest is deductible under paragraph 20, sub 1c. 2 prerequisites: at least 20% equity, plus an OSFI 65% loan-to-value cap from federally regulated lenders. A paid-off home has headroom. 25% equity has far less. The May 2026 rate stack. HELOC pricing runs prime plus a half to prime plus 1.5. We use 5.5 as the midpoint. Verify current rates before running this on your own household. $200,000 at 5.5 is $11,000 of interest in year 1. At her combined federal and Ontario marginal bracket of 44.97%, that interest is worth roughly $4,947 back. Here is what the brochure does. It compares the 6% gross return against the after-tax cost of borrowing and shows a 3% spread. That number is wrong, because the return gets taxed too. Margaret's household personal income sits in the band between $150,000 and $181,000. In that band, Canadian eligible dividends are taxed at 27.53%. Above $181,000, the rate climbs to 32%. Above $220,000, it climbs again. Pick the rate that matches the household's actual income before running this on a real balance sheet. $12,000 of dividend income costs Margaret about $3,300 in tax. Net the deduction in, subtract the interest, and the year 1 position is closer to $2,600 positive, not $6,000. If you read the CRA's own income tax folio S3F6C1, last updated August 2024, the position is plain. Borrowed funds must trace to an income-earning purpose. Year 2 is where it breaks. The third piece on the board is where the polished version stops covering ground. Year 2. The market does what markets do once a decade. The Canadian dividend sleeve drops 22% in 12 months. Margaret's $200,000 position is now worth $156,000, $44,000 of paper loss. And here is the part the brochure does not show. The HELOC interest is still due, $11,000 again. The deduction is still worth 45 cents on the dollar against her ordinary income bracket, $4,947 back. The after-tax cost of the interest is still $6,053. Dividends usually continue in a paper drawdown. On the reduced sleeve at $156,000, dividend income is roughly $6,200. After the 27.5% rate, about $4,500 net. So her year 2 cash and paper position, $44,000 of paper loss on the sleeve, plus $4,500 of after-tax dividends, less $6,000 of after-tax interest. Net year 2 number, roughly $45,500 in the red. Add it to the $2,600 of year 1 gain, cumulative position through year 2, roughly $43,000 behind where David sits. This is the asymmetry that brochures for this strategy typically gloss over. If Margaret were 33 years old with a 30-year horizon, this is a paper loss. She rides it out. The sleeve recovers, compounds, and the math works. Margaret is 58. Her horizon is now 5 years, not 7. A 22% drawdown on a leveraged book inside a 5-year window is not the same animal as the same drawdown inside a 30-year window. The recovery has to be larger and faster to pencil. It usually is not. The polished marketing focuses on what year 1 looks like. We are walking you through year 7. Margaret is $43,000 in the hole after year 2. Many households in this position reach for a windfall to fix it. And that is where the CRA rule, almost no one explains, lives. If this just changed how you think about your home equity, that like button is how other Canadians find this before they file. The second piece on the board is the one no one explains. There is a CRA tracing rule that breaks the deduction the moment the HELOC gets paid down. Year 4. Margaret receives a $40,000 inheritance and pays it against the HELOC. The instinct is right, but collapses the deduction. Interest deductibility under paragraph 20 sub 1c lives on 4 conditions: a legal obligation to pay the interest, borrowed money used to earn income from a business or property, a reasonable expectation of income at the time of investment, and clean tracing to the income-earning use. According to publicly available CRA data, the onus is on the taxpayer to maintain that tracing. When Margaret pays $40,000 against the principal, 20% of the original borrowing no longer traces to the sleeve. The math. Remaining balance, $160,000. Interest at 5.5% is $8,800, but only 80% traces to the original use, so deductible interest is $7,040, worth 45 cents in tax. $3,165 back instead of $49.47 before. After-tax effective rate climbs to 3.5%. Tax planners flag 2 perimeter cautions, both worth a pre-paperwork conversation. Caution 1. A separate trap lives in section 74.1 sub 3. Spousal attribution. If a higher bracket spouse borrows and the lower bracket spouse later repays the HELOC, attribution rules pull the deduction apart. A conversation for the household accountant. Caution 2. The cash damming variant. Cash damming is a structure available only to sole proprietors, partnerships, and unincorporated rental owners. A salaried employee on T4 income cannot legally execute it. The Supreme Court ruled on a related leveraged spousal structure in Lipson versus Canada in 2009. The general anti-avoidance rule applied. Tax professionals consistently advise against any compound variant without an advisor who has read that decision. The deduction shield is real. The tracing rule is the perimeter. One event collapses the shield even when the perimeter is clean, and markets are not where it comes from. And the last piece on the board, the one that makes the math break for ordinary life events. The deduction shield is calibrated to a marginal rate. 45 cents back on each dollar of interest assumes Margaret's household stays in the $150,000 to $220,000 bracket. The shield only protects when the rain comes at the angle it was designed for. Year 6. Margaret's spouse passes. Household income collapses from $150,000 to roughly $78,000 on her survivor and pension stream. Her marginal rate drops from 44.97% to 29.65%. Run the shield again. $7,040 of deductible interest now reduces tax at the 29.65 rate, $2,087 back instead of $3,165. The after-tax cost of borrowing climbs to roughly 4.2%. Cash flow on widow's income cannot service the HELOC the way the dual-income household could. She liquidates $80,000 of the sleeve in year 6. The sleeve is worth $172,000 at the time. Forced liquidation locks in about $14,000 of realized loss. The same asymmetry shows up if the marriage ends. The Ontario Family Law Act equalizes the full value of the matrimonial home. HELOC debt against the home is debt against net family property. The investment sleeve in one spouse's name is an asset. Year 7. Final accounting. Cumulative HELOC interest paid, $63,000. Deduction value realized over the 7 years, roughly $27,500. After-tax interest drag, $35,500. Dividend income received on the sleeve, net of tax, roughly $22,000. Forced liquidation loss, $14,000. Sleeve value at the end of year 7, about $98,000 on the original $200,000 borrowing. Net position versus David, who did not borrow. Margaret is roughly $32,000 behind. The strategy failed because the math was built for a horizon her household did not have. The wrapper that makes the math possible is what we walk next. The math is not bad. The strategy is not fraud. For it to work, the borrowed sleeve has to live in the right wrapper, and the income has to be the right kind. A quick affiliate note. This channel earns a referral if you open a WealthSimple account through the link below. That does not change the math or the wrapper the deduction requires. Margaret's $200,000 had to live in a non-registered managed account, not a TFSA, RRSP, or FHSA. Borrowed funds contributed to a registered shelter produce no taxable income inside the shelter, so paragraph 20 sub 1C does not apply. The wrapper also has to produce the right kind of income. Canadian eligible dividends in Margaret's range are taxed at 27 to 32%. Interest and ordinary income are taxed at 45%. That preferential treatment is the reason this strategy pencils at all. Strip it out, and the after-tax yield will not carry the after-tax cost of the borrowing. One trap inside the wrapper. Many popular Canadian dividend funds distribute return of capital alongside eligible dividends. Return of capital is not income. It is the fund handing back the investor's own money. If ROC is spent on personal expenses or used to pay down the mortgage, the deductible HELOC portion shrinks proportionally. The tax court ruled on this in Steenis versus the Crown in 2018, and the Supreme Court denied leave to appeal the following year. Before any borrowed dollar lands in a fund, the household must verify whether the fund distributes ROC, then choose to reinvest it, apply it against HELOC principal, or accept the proportional deduction shrinkage. WealthSimple Invest is one natural execution surface. It manages the sleeve, produces taxable dividend income for the reasonable expectation of income test, and handles rebalancing for clean tracing. Honest scope. WealthSimple Invest does not originate the mortgage or replace the tax professional who screens the strategy before paperwork is signed. WealthSimple published their own Smith Manoeuvre brand video on May 1st. This walk holds up at the worst moment of the cycle. Before any household commits to this strategy, tax professionals consistently advise running a 5-question screen. The same 4 pillars on the board are how it gets scored. Question 1. Is the investment horizon at least 15 years from today? Not the retirement date, the full holding period of the borrowed sleeve. Margaret had 7. The math did not survive. Question 2. Surviving spouse resilience. Can the lower-income spouse alone service the HELOC interest in a down market on widow's income? If the answer is, we will figure it out then, Planners read that as a no. Question 3. Can the household commit to never paying down HELOC principal during the strategy? Windfall paydown breaks the tracing proportionally, and the deduction shrinks with the principal retired. Question 4. Is the household certain it is not structuring this as cash damming or as a spousal attribution variant? Lipson versus Canada is still the binding scrutiny precedent. The CRA reads those structures with the general anti-avoidance rule in hand. Question 5. Does the borrowed sleeve produce taxable income from day one? Canadian eligible dividends qualify. Cryptocurrency, non-dividend paying tech stocks, gold, and pure capital gains plays kill the deduction entirely. Paragraph 20, sub 1C, requires a reasonable expectation of income at the time of investment. Capital appreciation is not income. If the borrowed money goes into anything without a documented distribution history, the CRA will deny the interest deduction on audit. Tax professionals consistently advise that any no is a stop signal, and that 5 yeses warrants a sit-down with a qualified advisor before paperwork is signed. Loop closure. Margaret hit no on questions 1, 3, and 2. The 4 pitfalls: rate spread shrinkage under sequence risk, the tracing break from windfall paydown, surviving spouse rate collapse, and the cash damming risk she almost stepped into. Together, they cost her $32,000 against the unleveraged path. The strategy is not the trap. The horizon is. And if the bigger question is whether the RRSP already in place is the one quietly costing $3,000 every year, that is what we are walking next. The decisions that matter most rarely arrive with a deadline announcement. Subscribe so the next one lands in your feed before you need it. If the question this video answered was whether to borrow against a home to invest, the bigger question for most Canadian retirees is whether the RRSP already in place is the one quietly costing $3,000 every single year. There is a withdrawal sequence mistake most households make in their first year of retirement that quietly costs $3,000 every single year for the rest of their lives. Same engine, different room. That is the next walk. I am not a tax professional. Run the final moves by one before you act. Thanks for watching.